Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the next slide is also moving average. An interesting question we can ask regarding moving average is which time frame to use. I want to say that it depends on your trading horizon. If you are a short-term trader, you would use short-term moving averages. If you are a long-term investor, you would use more longer-term moving averages like 100 days, 200 days moving averages. But it depends also on the asset analyzed. I mean that if you analyze Forex markets, sometimes you can see that the time frame on moving average, some time frame on moving average are better for Forex, and the same time frame won't be useful on, for example, commodities. It's an example. It's not a rule. So, for me, my favorite time frame are 20, 50, 100, and 200 days moving averages for a daily chart, and 30, 50 weeks for a weekly chart. I mean, when I take a chart, I have always on my chart, if I have a daily chart, a 20, 50, 100, and 200 days moving averages on my chart. And if I take a weekly chart, I have always a 30 and 50 weeks moving average on my weekly chart. This is my rule. It's not a rule in general, but this is my rule. The next slide is very interesting because it's a basis on technical analysis. You can't use only one technical tool. You use only trend lines. You can make a lot of mistakes because you can draw trend lines with different points. You can have a debate with another market technician because the trend line is not the same than him. So it's really it's not my favorite indicator, trend line. But with a combination with moving averages, you can have a certain confirmation of a downside or upside breakout of a trend line. So if you have also a breakout on the trend line and also the confirmation with moving average, we have two arguments to say, to be confident to take either a long position or a short position. On this example, we have the Dow Jones Eurostoxx 50. Sorry, it's not the S&P 500 or Dow Jones Industrial, but it's not the most important. On the first pattern, I drew bullish channel. Just there. Okay. So you have a clear bullish channel, but the downside breakout. We have a downside breakout during June 2009, but for me, it's not sufficient to take a short position just there. Okay, just at the downside breakout is not sufficient for me to take a short position. I prefer to wait, in this case, to close below the 30 days moving average on this chart, which is just there. Okay. Sorry. Okay. So there you have the downside breakout, the lower boundary of the bullish channel, and you have a close below the 30-day moving average. So we have two arguments, and I have a stronger confidence to take a short position just there. Okay, so the short position is, if I take a short position, it's just there. Okay, so so you can see that we had a sideways trading during 1 or 2 weeks, but the signals was interesting because we had a deeper consolidation on the index. Yeah, in fact, it was a pullback on the 100 days moving averages, because the empty outlook had turned bullish in April, May 2009, and this pullback was, in fact, actually was a good entry point, because it was exactly a pullback on the 100 days moving average. Okay. So on the second pattern, we had a bearish trend line. Okay. The index has broken above this bearish trend line. We had bullish acceleration, but afterwards the market started to consolidate, but the index has broken below this former bearish trend line. But when you break above a resistance, the resistance is becomes a support. So just there was a support, but the index has broke because this former resistance, which was a new support, but also the index has closed below this key 100 days moving average. So just there we have a strong short, we have a strong short position signal. Okay, so just there you can enter a short position with a strong confidence, because you have two arguments, two developments to say that the trend has turned bearish with the downside breakout of the former bearish trend line and the close below moving averages. So that's why it's very important to have a combination of trend lines with moving averages to avoid false signals, especially on trend lines. Because for me, from my view, moving averages, we have less false signals on moving averages, and we have a lot of false signals on trend lines. But the combination with these two indicators is the best combination to take a position on the market. So that's it for trend lines and moving averages.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.